So these private equity firms, kind of like Bank of America saying, well, if we hold these treasuries to maturity, we don't have to take any losses. Well, in private equity, they can say that this widget is worth anything, or this stock or this real estate is worth anything. It is not based on current market valuation. It is based upon whatever they say, and it's opaque. And these limited partners, these LPs, really don't have much say in what happens at this point. And when they were making lots of money, who cared? You didn't want the say. Now the tables have turned. But the balance of power is shifting within, they're saying, the $8 trillion private equity industry as buyout funds struggle to return money to investors amid disagreements between buyers and sellers over corporate valuations. Wait, we want to know how much our investment is actually worth if you are forced to sell. Well, they can't at this point. The limited partners cannot force the fund to sell. Can you see the looming problem? Can you see the battle? Because that's handing more power to limited partners to dictate the terms of the engagement, and they want more transparency. They want more say. And I'll show you why. Just hang with me here. You definitely have to see this. Private equity business takes companies private, then sell to market for a profit, okay? But the fundraising slows. So again, in every Ponzi scheme, you have to keep getting new money in. And investors are turning cautious in private equity. So while it exploded, right, since the arena of 2008, once the Feds shifted their zero interest rate policy, so did the ability of that free money to flow into the fund. And what we're seeing, there you go, is that it is now near the lowest level ever. And 2010 was a pretty tough environment, if you guys remember correctly, because private equity relies on cheap leverage, and higher interest rates are limiting institutional investors' appetite for the strategy, making it more urgent to find new fields to plow. In other words, new investors are required. Now you're talking about very sophisticated investors that were going into that. But now they see what the problems are. They're not getting their money back. They have no control in these markets, and the markets themselves, the valuations are imploding. So how can they transfer that risk? And who can they transfer that risk to? And before they transfer that risk, how can they make their assets appear to be on solid ground so that they can attract those new investors? Like maybe you? I hope not. Private equity is piling debt on itself like never before. Shocker. Private equity firms have been increasingly adding another layer of debt to their complex borrowing arrangements. It's not clean cut. It's not obvious. It's complex borrowing arrangements, raising concern among some investors about potential risks to the wider industry and the financial system. You think? Because the investor universe is unbelievably unaware of the underlying leverage throughout this entire ecosystem. Now look, leverage works great in a debt-based system when everything is on the way up. But when the implosion occurs, all that wealth transfers. Now, frankly, if you are in the right place at the right time with the right asset, that will benefit you. That's part of the strategy. That's just based on repeatable patterns in history. But yeah, it's so complex. And what do they say? Even the big guys, they say, if we make it really complicated, nobody questions us. Well, trickle down. They made it really, really complex. That hasn't hit the private equity investors yet because they're stating how much the valuations are. But the investors are starting to question that now. But it's becoming more clear for real estate investors, and that is going to trickle down as well because a lot of this private equity is based on commercial real estate. So let me show you how this is being set up. And first, I'm going to show you just 2 of the new complex tools, okay? This is levering up. Private equity firms pledge more collateral to raise debt. So that's that hypothecation, which is throughout the banking system. And remember, there are, if you do this in the US, there are going to be some level of limitations, like 140%, I think, of how much you can leverage an asset. So this is what the asset's worth. You can leverage it to 140%. I don't know. Can you see a problem with that? Okay. Not if inflation is pushing the valuations in terms of fiat to new highs, right? But when the opposite happens, the opposite happens. So there's a new product called Management Company Loans, ManCo. And that is a more recent phenomenon, so there is absolutely no data available, even showing how many of these they've done. Well, okay, what's the collateral? The collateral, the fund manager's fees and the returns from investments. So if you're having to shift who's actually making these investments, from the sovereign wealth funds, from those that are stable, that aren't maybe going to care as much about the fees, to the more general population that will be competing with low fee ETFs, etc., those fee structures are going to matter more. Plus the investment returns. Okay, well, if the investment is losing value, how good is that collateral? But that's the collateral for this loan that's set up. And what is it financing? Well, it's financing 3 things, basically. Larger commitments by general partners to their own funds. So they're keeping things afloat as the current investors are trying to demand that they can pull their money out. Also, mergers and acquisitions, again, to expand their base. But this is in a falling valuation environment. And lastly, and this is the key one, frankly, succession planning, or buying out other partners. So in a Ponzi scheme, you bring in new money and pay out those that got in first. That's what they're really talking about here. And what's the cost on those loans? Well, somewhere between 10 and 19%. Pretty hefty fees, I think we'll all agree. Now, another new tool that they've created are net asset value loans. Of course, the true net asset value of these funds are opaque, right? They're stated. Well, this is how much we think it's worth. What's the collateral? Okay, the collateral, oops, went a little too fast. The collateral is a pool of portfolio companies' capital that investors commit to private equity funds. So again, they gotta get new money, plus they're using the funds that they already have that are stated valuations. I just don't want you guys to get caught up in it because of FOMO, which a lot of people do. I want you to see the truth of what's happening in here because it's a huge threat. Now, what's it financing? Growing portfolios, returning money to investors, and it prevents selling portfolio companies or limited partner positions at discounts because they don't want anybody to know that they are imploding. So again, they need new money to take care of the old money. And smart new money is not coming in. And even smart current money wants to be pulled out. And what's the cost of that? 10 to 12%. Can you see the issue? Because if the value of the fund drops, for example, you're looking at a margin call situation, which means a freaking fire sale. If they do not get new money and these limited partners demand repayment, it is going to be obvious to everybody that this is imploding. And all of this leverage could easily threaten the global financial system. There are so many black swans that are circling. It's scary. And it would be like a volcano meets a tornado. Who is surviving that? Plus, food, water, energy, security, barterability, wealth preservation, community, and shelter. Get it done. We only have as much time as we have. Get it done. Do you want to be inside of a volcano erupting while a tornado is also impacting you? No, you do not. This will protect you, and so will having everything that you need to sustain a reasonable standard of living. And again, I go back to community being the single most important issue that we're talking about, because you don't have the luxury of the time that I had as I've been building my bug out and building my community. So I think it's critically important that there are two communities you focus on. The local community, so that you can bring your talents together to survive this mess, and the global community, so that when they're trying to cram these CBDCs down our throat, you have the ability to say nope. And enough of us have the ability to say nope so that they cannot do it, and we can go into a more fair system.